Welcome back. My name is Arya and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, we're doing a bit of a follow-up to the video I made last week talking about how PayPal seems to me to be a very clear case of disruption and innovator's dilemma, a company that is going to continue to shrink over the next 5 to 10 years, and I don't think their pivot into advertising or e-commerce, the odds of them being able to pull off something like that is slim at best, and this would likely translate to poor shareholder returns in the future. In today's video, I'd like to offer you the better fintech play, in my own personal opinion, that I'm also invested in. Fiserv with an F at the start, not to be confused with the popular healthcare company. This is the better fintech play that should translate to better shareholder returns, both in the, call it medium term, the next couple of years, and over the long term, as I think they are still strategically positioned to benefit from the secular growth of payments around the world. Their moat is intact across their many different segments. It's actually a bit of a payments conglomerate, which is a bit confusing. So I'll hope to kind of dissect that down a little bit as we go on in the video here. And then, of course, I'm going to make the case that this is a better sort of buyback play or share cannibal play, because that's kind of what the PayPal crowd is arguing. It's like, okay, even if they don't work out in terms of the new initiatives that they launch, it's still a lot of buybacks, and that should translate to good returns. I'm going to argue to you that Fiserv is actually the better buyback play. And so, again, we'll dive into all of that here. Now, the first part of the video, I kind of want to go through what they do, because I doubt that a lot of you are actually familiar with the business or anything like that. And so to do that, I'm going to use Fiscal AI, which is the sponsor of today's video. They are also the greatest stock research platform in the world, giving you unparalleled breadth of data across global equities, and additionally uniquely aggregated segment and KPIs data on over 2,000 different companies. And so with that, I'm actually going to use the segment and KPIs page to show you the different segments, to show you the 6 different segments of Fiserv. And between the 6 segments, we can sort of categorize them into the legacy components of the business and the more newer age section of the business. And I would argue roughly 4 of these different segments fall under the legacy component. So they have the banking segment, they have issuing segment, digital payments, and also processing. As highlighted by the Morningstar report, these components of the Fiserv conglomerate are very wide moat entrenched core processing systems for banks. They're highly mission critical, and the 99% retention rate that this segment of the business benefits from kind of speaks for itself. Essentially, unless the banks are merging and consolidating their contracts with Fiserv, there is no churn in terms of these sort of softwares and services that they provide to these banks. It's often described as the nuts and bolts system that the banks need to maintain their deposit and loan accounts to post daily transaction. It's very, very core banking services, for example, to like open a new bank account, manage loan originations, deposits, again, daily sort of transactions being posted. These things require Fiserv's various different services. The main thing you need to understand with it is that it's essentially payments infrastructure. And again, the 99% retention rate kind of speaks for itself. This segment of the business goes as far back as 40 years ago. They've been providing these services to a variety of different banks. And then furthermore, they're by far and away the leader in this segment. They have roughly a 37, roughly maybe 40% market share in this core banking sort of services that they provide. And it's such a legacy old component of the business. It should be growing at inflation plus a couple percent, just purely off the back of, more people opening up more bank accounts and so on and so forth. Just the industry sort of volume growth over time. And it's very high margin. These banks cannot switch off of Fiserv's tools, even if they really wanted to. They'd have to retrain employees. There would be disastrous consequences if the new integration to a new system were to go wrong, so on and so forth. The switching costs are very, very high. This is a super wide moat segment of the Fiserv conglomerate. Now, the core banking, quote unquote, is only these 3 segments here. And then there's also a processing revenue line here. This is by far the smallest segment of Fiserv's conglomerate. This part of the business is actually the card network that they have, not for credit cards, but specifically and only for debit cards within US and Canada. They are the 3rd biggest debit card network. Well, I guess if we include American Express and stuff like that, then they'd be further back. Oh, actually, sorry, American Express doesn't do debit. I believe they don't do debit. Anyways, Fiserv is the 3rd place debit card network provider. Now, before you get excited, this is actually probably the worst segment in the business because it's not growing, and in some cases, it's actually been in decline. But nonetheless, again, a legacy part of the business that they've had for many, many years that is most likely a very high margin, just cash cow that they can use to put into more accretive buybacks or acquisitions and so on and so forth. And so here we get into the exciting components of the business. By my estimation, about 2/3 of the incremental growth of the business comes from these segments that I'm about to mention. There's the enterprise organic revenue, and then there's also the small business side of the business, which is, I believe, the biggest revenue driver. So the enterprise, this is similar to like an Adyen, a Stripe or something like that, where it's like a merchant acquirer. Fiserv is the second biggest merchant acquirer behind JP Morgan. Last time I looked at this, I believe they have roughly a 13% market share, whereas JP Morgan has something closer to like 18 or 20%. And you'll notice there's a couple familiar names on here. Like I mentioned, Stripe is on there, Adyen is on there, PayPal is also on there. Not to be confused with PayPal, the checkout button or anything like that, or the PayPal wallet even. Technically, the wallet for a merchant would be an acquirer service, but this is specifically, I believe, the Braintree segment of PayPal. Again, it's a very much B2B service of processing payments for something like an Uber, an Adobe, Airbnb, something like that. These big enterprises. And so as you can see, second biggest on that front. And I believe the growth on this segment is about 15% year over year, if I remember correctly. And lastly, the small business segment. This is these payment terminals that Fiserv sells. Clover, I'm sure, particularly if you live in North America, I'm not so sure about Europe, but if you've gone to the mall at any point, or especially if you go to restaurants, for example, very frequently, if they have one of these new age payment terminals, it's probably one of these. Very similar, by the way, to something like the Square terminal. This is another very popular terminal that I'm sure you guys have seen just going out and about. You've probably transacted on one of these. So Fiserv's business model here with the Clover is to essentially charge just a small percentage of every dollar that flows through that payment terminal. And it's a fantastic business because, one, they sell the hardware, and that's good. Additionally, the volume that flows through, they take a percentage of that. And then on top of that, about a quarter of the merchants of Fiserv actually pay for ongoing services and value-added services and softwares and stuff like that, analytics to see on the payments that are flowing through their system, so on and so forth. And it's a very, very high margin business on that front. Anyways, now that we've gotten through sort of what the company does, I hope I've given you a pretty good overview of the various different services and the large conglomerate that is Fiserv. Let's dive a little bit into the numbers. And so if you look at it on a revenue basis, it's not that impressive. And I know I've been on record before saying that I prefer businesses that have their top lines growing in excess of 10%. This is absolutely true. I think every single company in my portfolio other than Fiserv meets that criteria. Fiserv, on the other hand, on a GAAP basis is growing at about 8%. They do have an adjusted number that they throw into their earnings called organic revenue growth. They take out some of the effects that happen as a result of some of the merger and acquisitions that they do, so on and so forth. That number on a revenue basis is growing closer to about 10%. Nonetheless, this is pretty much a high single digits revenue grower. But the part where it gets interesting with this company is the ungodly amount of buybacks that this company has been doing and will be doing on an ongoing basis. And I'd like to take this opportunity to make a key distinction between these two metrics that I see people, particularly on Twitter, kind of use interchangeably, especially when it comes to PayPal. There's a difference between buyback yield and the percentage reduction of the shares outstanding. The buyback yield, for example, PayPal shareholders would say, PayPal has pledged to do $7 billion of buybacks. It trades at a $70 billion market cap. Very easy math, 7 divided by 70. You land at 10% buybacks. That's not how it works. Because on the other side of that coin, PayPal is sitting there and doing and issuing a lot of shares as a part of their ongoing stock-based compensation plan for their employees. So the net result of that is, sure, you've bought back 10, but if you've diluted by 3, the net of that is you've only bought back about 7%, right? You buy back 10, you dilute 3, and the difference is, of course, 7%. And so if we look at something like Fiserv today, yes, the buyback yield is on a trailing basis 10.6%. Now, this doesn't mean that they've bought back 10% of the market cap, because they haven't. If we throw on that metric, you'll see that, in fact, they've actually bought close to half. They bought about 6% of shares outstanding over the trailing 12 months. Now, this is a result not because of the excess stock-based compensation that the company does. In fact, I could show you that as well. And by the way, this is why I preach Fiscal AI is so powerful, is because I'm able to kind of visually see these different metrics. Feel free to try it out, by the way, with the link in the description down below. There's a 2-week free trial for it, no card required. But like I was saying, if we bring in both the free cash flow and the stock-based compensation, you see the stock-based compensation actually doesn't have that much of an impact on the free cash flows. They're not diluting by that much. If we were to bring up PayPal for this same metric, it would be about a third. So they're doing about $7 billion of free cash flow over the next 12 months. Currently, they're doing, I think, about 5. And just off my memory, I think they're doing $1.5 billion in terms of SBC. So a little bit of a step up compared to Fiserv. So then you might ask me, Arya, why is the shares outstanding so low? And the reason for that is because they were doing these share repurchases over the past 12 months at higher prices. So I think it's probably best if I just show you. If we toggle the stock price and we overlay it with the repurchase of shares, you'll see that they were essentially doing share repurchases equaling to 1.3 billion, as high as $235 a share, or just in the 200s in general. And then as the stock has fell more and more, they've continued to dip into the bank a little bit more and continue to repurchase. Long story short, yes, they've done $7 billion of buybacks, but those $7 billion were spread from $250 per share all the way down to $120. But then, if the company continues to trade at these levels, and as they've pledged, they will be doing at least all of their free cash flow towards buybacks, if not a little bit more. They're going to continue to kind of borrow debt and use the very small cash balance that they already have to be able to fund these buybacks, because they think the shares are so unbelievably attractive. If that happens over the next year and the valuation stays the same, at that point, they'll be buying back 10% of shares outstanding. But this kind of brings me to my next point. I don't think it's sustainable for them to continuously be borrowing debt. In fact, they have a lot of debt as it stands currently. That's if I were to point out one of the issues with the company, by far that is, in fact, probably the biggest glaring issue, is that they have about $30 billion of debt on a market cap that is just shy of $70 billion. Nonetheless, they know they've had a long track record of being able to manage this debt, be able to refinance it, and kind of do a balancing act of dipping into buybacks when the valuation is cheap. And then when the valuation goes higher, they do a little bit more on the debt pay down side of things, and they kind of pledge their free cash flow to pay down more of the debt. There's a management team that has a track record of 40 plus years, sort of running the same playbook over time. And so although I don't love it, it's not a big worry for me personally. I think they're smart enough to know to kind of play that balancing act game. And so we look at, for example, the forward PE, which is not a perfect metric, by the way, because again, they have a boatload of debt. But as you can see, the company trades at a 11.5 times forward PE multiple. If you look at PayPal, for example, it's a very similar story. I believe their PE is actually a little bit higher. It's about 12.5. So you have a company that is trading at a little bit of a discount to PayPal. It currently has no outstanding disruption issues. Yes, it's a competitive industry, particularly on the merchant acquisition side of things and the Clover side of things. That's definitely the case. But isn't PayPal as well? I mean, even at a bare minimum, if we're being fair, you have to admit that PayPal is in a sea of competition across all of the business lines that they compete in. One of the segments that accounts for most of the growth for Fiserv is the merchant acquisition side of things, particularly with Braintree on PayPal side of things. They share that business. And actually, it's growing about the same amount for both Fiserv and PayPal. Anyways, I'm going on too many side tangents here. The point is, you have a business that trades at roughly the same valuation, if not a little bit cheaper. They are doing roughly the same amount of buybacks, if not a little bit more over particularly the next year. While PayPal, again, you have to admit, they are facing a lot of competition. They are facing existential crisis and possible disruption over the next 5 to 10 years. That's just a fact. With Fiserv, on the other hand, the core business is without a doubt that super wide moat. No questions asked about that. That's going to kind of trug along and be able to do that 6 to maybe 7% revenue growth over the coming years. Sure, there is some questions about the Clover side of things and the volume declines and so on and so forth. But nonetheless, that's an industry, which I can actually show you, where the secular volume growth alone is close to 10%. It's estimated to be about 8.7%. Over the past roughly 5 years or so, it has been higher because of obviously the COVID boom and so on and so forth. But anyways, as one of the top 4 players in the industry, they should be able to see roughly industry growth, maybe a little bit more. So I'm not too worried about that. The Clover segment alone should probably do 10% volume growth, maybe 5% in hardware sales, another 5% at least in value-added services. By the way, the company themselves is guiding for 30% growth. I really think it should be at least 20% conservatively over the next handful of years. And a lot of people make the argument of like, oh, it's super competitive, so on and so forth. There's Toast, there's, Square, there's Shift Forward payment terminals, there's legacy terminals that's owned by private equity. It's such a crowded space. As one of the top 4 leaders in this industry, sure, it's competitive among them and maybe it's a race to the bottom, so on and so forth. I'm not denying that, but you should be able to see most of the industry just pure volume growth over time. I think that's been used as a bear case in a lot of different industries, and some of them have gone wrong. For example, you look at like Monday.com and stuff like that. It's in a very crowded project management space. There's a lot of different startups and so on and so forth. It's a little bit less switching costs than something like a Salesforce, etc., etc. And of course, there has been growth slowdowns over for that business as well. But I think that's used in a lot of cases incorrectly that, oh, it's too competitive. I can't invest in that. I'm not saying go out and put your entire portfolio in it, right? Like, this could serve as a pretty decent risk versus reward bet, particularly when you consider that this company is trading at a 12 PE. So anyways, to kind of summarize my thoughts, I think this is a better opportunity than PayPal because frankly, it's not facing the disruption risks that PayPal has. And additionally, you have significantly better growth. If you have a top line that grows at about 8 or 9%, let's just be more conservative, say 7%, and then you throw on anywhere between, say, 7 to 10% in buybacks, that should translate to 15% plus earnings per share growth for the next handful of years. Yes, it's not perfect. Yes, there's debt. Yes, it has a crowded business, but so does PayPal. And at the same time, we're not even ruling in the possibility of multiple expansion in that scenario. I made this tweet a couple days ago, and I'll link it in the description if you want to read the full thing. But essentially, at the very bare minimum, sort of, I don't think it gets more conservative than this. If we apply a 7% buyback, 8.5% revenue CAGR, which again is just, that's very, very likely to happen. You apply a 25% free cash flow margin, which is just no improvement over the next 3 years. That's the free cash flow margin that they have today. And the PE stays at 12. You still end up with a 15% CAGR on your stock. That's a double. That's on pace to be a double in 5 years, right? Let's just say it goes to a 15 PE. Or in this case, sorry, I'm doing price to free cash flow here, not PE. But let's say it goes to a 15 price to free cash flow. That's a 25% stock CAGR. That means the stock, which today is at $125 per share, will be $240 by the year 2028. That's roughly a double. I've now brought up the price to free cash flow chart of this business over the past decade, and post 2019, it is a different business. That's why you see all these like random fluctuations here. But nonetheless, over the past decade, they've averaged a 23 times price to free cash flow multiple. Over the past 5 years, if we zoom in, which this would specifically look at, post acquisition, again, they've averaged that same sort of 23 times price to free cash flow multiple. So to say that this is a unique opportunity and it's a unique case in the history of Fiserv would be understating it. This has happened only once. I suspect you would have to go all the way back to 2008 to see Fiserv at a cheaper valuation than it's trading at today. And I also suspect over the next, maybe it doesn't happen in the next quarter, maybe it doesn't happen in 6 months, a year, whatever. I suspect over the next, most likely year and a half to maybe 2 years, this company will eventually re-rate to a higher valuation because we put these Clover growth fears behind us. The narrative changes on the company. They continue to do these very accretive buybacks, and the company re-rates to a higher valuation. I'm not suggesting it goes back to 23 times free cash flow, but even if it re-rates a little bit higher, you end up with a 25% CAGR. And then at the same time, even if it doesn't re-rate at all, you're still getting a 15% CAGR. One of the members of my Discord, which by the way, link for that in the description as well, if you want to join, but one of them said, this is a case of heads, you win massively with the stock, it re-rates and it goes up and they do a whole bunch of buybacks and the Clover volume growth re-accelerates, so on and so forth. Tails, you end up outperforming the market. So essentially, there's no downside. You end up outperforming the market. Actually, the only scenario where it doesn't outperform the market would be if the valuation continues to slide down. It goes to like 8 times free cash flow, 7 times free cash flow, which at that point, you're trading at the same valuations as General Motors, the car company, who's been in decline for the past 20 years and is being disrupted by Chinese car manufacturers. So unless that scenario happens, I think you're fine. Anyways, as always, not financial advice. You guys know what I'm doing with my portfolio. Actually, I should mention, but I'm going to save it for a different video. I have slightly adjusted my approach to being invested in this company. I'm no longer holding common shares. I have bought my first ever call option, and I bought pretty deep in the money call options. It's pinned at the top of my portfolio, it's pinned at the top of my Twitter page right now, and I kind of explained what the strike was and what price I bought it at, so on and so forth. My thought process a little bit with that. I'll link this in the description just in case you're watching this at a future date. But yeah, essentially I did what Bill Ackman did with his Nike position, where he sold the shares to buy long dated leap options. That's what I did. They have a $100 strike for January 15, 2027. Again, I'll save this for a different video with more detailed explanation of my thought process and my findings and learnings and everything like that. But yeah, we can't really track that on fiscal at the moment, unfortunately. So this cash position here is meant to represent the cost basis of those shares. And again, I essentially converted the equity shares into a long-dated call option. So that's my exposure to it. By the way, that actually increases my risk towards the stock. So if the stock is flat or down over the next year and a half, I actually stand to lose a lot of money. Upwards of 10, 20, 30, 50% in some cases, depending on, the strike and so many different things. But yeah, if the stock is down 10% over the next year and a half, I'll lose like 50% of my money. But at the same time, if the stock is up 100% over the next year and a half, I'll stand to make 200, 250% just based off how that option works. This is the same thing that Bill Ackman did with his Nike position a couple quarters ago. So yeah, I'll save that explanation for a different video. But yeah, just to kind of have that on record. Thank you very much for watching. If you enjoyed the video, I'd like to ask you of two things. One, get the Fiscal free trial. We used it all video long. It's a fantastic, fantastic research platform. And it's actually a method of education for you because you see these visual charts and you intuitively start to understand the numbers behind the madness that is investing in the stock market. And item number two, if you'd like to come hang out with me and 300 other investors, I do have a Patreon or Discord, which you can join. Price of a coffee, come hang out. We'd love to have you there. Thank you very much for watching and have a great day.